Anytime you're investing in an industry, it pays to hold the number one player. I mean, just ask Amazon, Meta, Google, Apple, how much it's benefited them to be the name brand in their industry. Well, if you're looking at Canadian natural gas, the name brand is Tourmaline. And today we're going to be talking all about this company, all about sort of what they do, what makes them special, the sort of unique investment thesis behind this company, and the amazing returns they have given to investors in the last 5 years. And finally, I'm going to cap it off with sort of my own personal thoughts about whether or not this makes sense in my portfolio and maybe if it would make sense in yours. Welcome to Golden Arch Investing. My name is Liam. On this channel, we love to talk about Canadian investing. Today, it's a classic video. We're talking about a big Canadian company, natural resources. Love to talk about this kind of stuff. And if you like to look at these kind of videos, please do subscribe to the channel and like the video. It means a huge amount. Doesn't cost anything. In order to talk about Tourmaline, you have to talk about Mike Rose. And I've got his sort of story beside me on the screen, and it's fantastic. I mean, before founding this company back in 2008, he was the president and CEO of Duvernay Oil Corp, or Duvernay Oil Corp. I don't know how French that is. And of Berkeley Petroleum Corp. He ended up making $5.9 billion. He's got a whole bunch of accolades throughout his career. But I really do think this company must be his crown jewel, because the success this company has had since he founded it back in 2008 is just fantastic. It's huge. I mean, today they're sitting at a market cap of about 25 billion Canadian dollars, and they've got yearly revenues up in the billions. Just fantastic numbers. I'm sure Mike is super proud, and this is really a guy who seems to be on the pulse of Canadian energy and just the whole sector. He kind of knows where to be. He's had a couple of really good business ventures, and this one obviously is going fantastic. So this is definitely somebody that I would be comfortable having my money with. And of course, the story of this company is very similar to a lot of the other big Canadian energy companies, right? We're talking about Northwestern Alberta. We're talking about Northeastern BC. We're talking about the Alberta Deep Basin. We're talking about the Montney Gas and Peace River Triassic basins. Right? These are huge energy resources that lots of companies, basically every Canadian energy company, is invested in. These guys are just doing it a little bit different, and a big part of that comes from their management team, who has clearly made some like really solid acquisitions, just like lots of the other big companies today, and they've done a really good job of just like picking their niche. And I can't talk about niche with a company like Tourmaline without talking about natural gas. Because clearly in the energy space, that is where they've focused. And it's the reason that today their name brand in the natural gas space. They are the number one Canadian natural gas player. And it really is a huge part of the business. Natural gas is still over 50% of revenues. And with other items that are all sort of related, right? Like oil and condensate and all sorts of other stuff that fill out the list. Clearly they've put themselves in a direction here, focusing on natural gas. And I think the best thing I can do for you guys is just dive into some numbers. And I've got all these numbers courtesy of FinChat. Shout out to them. Not a sponsor, just love the service. And they're Canadian, which is always great to see. Let's start at the top line here. I'll toss this up on the screen. We're talking top line revenues, $4.5 billion in the last 12 months. There's a 10-year compound annual growth rate of 13.7%. with a total change of 250% in the last 10 years. Huge. Obviously, that's had some really up years. If you look at 2022 here, that's huge. But if you remove the outlier, you see 21, 23, 24 are all kind of in the same range. And they represent a huge jump up from what we were seeing back in 2020 and before. Their profit margin is also fantastic. Their gross profit margin sits at over 50%. It's been compounding at 9%. So not quite as fast as revenues, but very profitable. And a gross profit margin above 50% is huge. That's quite a lot of profit. And one of the most impressive stats here I'll toss on the screen for you is the EBITDA, earnings before interest, taxation, depreciation, amortization, which has outpaced their total revenue number at 13.9%. So it's up about 5% more over the last 10 years. But still, it shows that not only are they growing, and growing pretty fast, right? Like a compound annual rate, almost 14%, is very impressive. But also they're being more profitable step by step as they grow. So very impressive. And clearly clearly from these numbers, you look at every single one of these charts, you can see that a huge chunk of the value of this company, of their revenues, of their earnings, of their profits, it's tied to the commodity price of natural gas. When you see that price spike, this company will as well, which is part of the reason why I'm so bullish on it. Okay, let's keep working down the list. Dividend numbers, huge, right? Energy investors, myself included, we love dividends. It's one of the reasons actually I got sort of into the energy investing space, because I was so focused on dividends. I was looking for great Canadian dividend companies, and this sector represents a huge part of that. So again, let's look at some of the dividend numbers. 6.1% dividend right now. Payout ratio of 28%. So really strong dividend. That's above 5%. That it's in that 5 to 10 range. That's what I would call a high dividend right now in more or less any industry, right? That's a good number. You would be expecting that from, you know, a company that doesn't grow, right? That like some of these companies where the dividend is the reason to invest are paying a dividend in that range. These guys are growing and paying that. Fantastic. Payout ratio. So like how covered is that dividend? How much can they afford it? How much of their sort of free cash flow is going into that? 28%. So that's not a huge number in all honesty. That could be much higher. There are lots of other companies out there who have much higher payout ratios. We've actually talked about some companies with higher payout ratios on this channel, and I've been positive. So seeing that payout ratio below 30% is quite impressive to me, especially considering their growth, right? They're continuing to grow. They're continuing to be profitable. Now here, this is the number. If you're going to watch one thing and listen to one number, look at this dividend growth number. We are talking a 3-year dividend growth, 25.7%. 25% growth on the dividend? That's insane. That's insane. And listen, do not take this as me saying that 25% is staying, that it'll constantly grow at that rate. I'm not saying that. I have no idea. I can't imagine that the dividend could grow at that rate, but that is the highest number that I have seen on a mature company anywhere. And if there's one that's higher right now on like a big mature firm, and I'm not talking somebody who just started paying a dividend, but like on a company that's been paying dividends, please let me know, because that's huge. That's a massive number. Wow. And it just, as a dividend growth investor, you start to look at how fast that dividend is going to compound, and 25% makes things look really exciting. Okay, well, now that we know they have a great dividend, we have that kind of in mind. Let me move on to my next set of numbers here. Total return. I think the best way, my personal favorite way to evaluate a company right now, when looking at like how they've performed for investors over the last 5 or 10 years, is to look at that total return number, because so many of these kinds of companies, particularly in this space where they're talking about resources and are paying out a good dividend, if you just look at the price action or you just look at the dividend, you're missing the story. A company with a great dividend but flat price is not as good as a company with a great dividend and a good price. Same the other way. A company with a great price appreciation and no dividend is not as good as a company with good price appreciation and a good dividend. The total return numbers are pretty awesome, guys. They're pretty awesome. Let's look at the 5-year chart. And I need to point out the 5-year chart, we're in 2025. We're not quite at COVID yet, looking at January 25 or 2020, but that 5-year number is sort of reflecting that COVID drop era. And because of that, we're looking at a compound annual growth rate of 45%. In my notes, I had this like underlined exclamation mark, 45% compound annual growth rate. That's crazy. 550% in 5 years. You're literally doubling your money every year if you invested in 2020. That's wild. On a Canadian dividend paying resource company that's not like a micro cap, this is a $25 billion business. We're talking 550% 5-year growth. This is not a junior minor. We are not talking about a small cap tech stock. This is a Canadian oil and gas company. 550%. Fantastic. Okay, let's spread it out to the 10-year and stop getting so fangirly about the 5-year numbers, because 10-year numbers, not as great. If we pull out 10 years, we're looking at 2015, so before that sort of late teens crash in the Canadian energy space, and we're looking instead at a total change of 171%, 10-year CAGR of 10.5. Okay. But I think really, really crucially, when we look at that 5-year number and we see just how fantastic it's been for this company, think about what could happen now if we have another bust period, right? I don't know if we're necessarily in the boom now or building up to a boom in Canadian energy. I would hope that we're building up to a boom rather than this being sort of the muted boom of the last 5 years and we see these things run out thanks to geopolitical tensions or whatnot. But think about just the kind of gains you can get by buying the dip in a company like this. If you pick a time when things are not looking so great for the industry, yeah, life-changing money, almost 6 times on your money in 5 years. That's, again, the kind of stocks that you have to invest in to 6 times your money, the kind of risks you'd have to take compared to what this company's offering you is fantastic. So I am blown away. I'm almost speechless, right? I don't know how well I'm keeping it together just looking at that kind of number. When we're talking about a large cap Canadian company, when do we see this? Never. We never see this. Okay. Let's talk a little bit about the future. Okay. All of this also coming from FinChat. Beautiful platform. They help me a lot when I'm researching companies like this. Got some notes. Specifically, I'm taking all of this from the Q3 2024 earnings report. That's the most recent data we have available to us right now, where we can actually get transcripts of executives talking about, okay, what are the plans for Tourmaline in the future? What's 2025 looking like? And sort of they tell us a little bit about what they're planning on doing. And I'll talk about a couple of things. I didn't pull every single thing out, obviously. I don't want to have an hour-long talk with you guys about all of their future plans. But there's a couple interesting things on here. One of the first ones I have, they're putting themselves in a position to expand capacity rapidly if the price of natural gas improves. And they specifically say in the second half of 2025. So they've put some money aside, right? They've put money on the side. They've made some moves already. They've been sort of building out an inventory of what they call, let me see what they call them here. Basically, wells that aren't operating yet, but are drilled. And they're sort of in a position where they could rapidly increase their production. Natural gas isn't necessarily going to improve though, right? So they're in a position to expand, but they're not sort of taking the risk of already expanding. And they aren't banking on that expansion because they're also, as you see here, working on optimizing free cash flow, which they plan on doing, generating $1.1 billion in free cash flow annually over the next 5 years at current pricing. So if we don't see any increase in the price of natural gas, we're still going to see $1.1 billion in free cash flow annually over the next 5 years. So they can continue to reinvest, refine, build efficiencies, build their dividend without having to count on that money. I think that's fantastic. And again, they've got that inventory of drilled but uncompleted wells. They're not quite ready to produce it, but it takes very little extra work to get those wells going at any moment, right? And we have seen, right? Again, I've mentioned 2022 a couple times. Only takes one big event to suddenly spike the price of natural gas, and none of us know the future. I mean, I assume unless you actually do know more than the rest of us about sort of the geopolitical events coming in the next couple years or so, I would assume that we're all sort of looking at the same kinds of risks, right? There's certain areas in the world that have all sorts of geopolitical risks, certain areas that maybe are a little bit more stable, right? I would argue Canada's probably a little bit more stable. That's my contention. That's one of the reasons I'm so comfortable investing here. Lots of parts of the world that aren't quite as stable and are looking at more potential for geopolitical risk. And so if any of those risks materialize, you could see the price of natural gas shoot up again. All of a sudden, these guys are sitting on a bunch of wells ready to go at a moment's notice. But that doesn't help them at all if they can't export any of that natural gas, obviously. Well, that's where this next section comes up, because they are prepared for that increase of LNG export projects that are coming online in that 2025-2027 period. And they mention all North American, because yes, we are talking about a Canadian company. Yes, obviously, it would be easier for them to export it from the coast of Canada, but that's not typically how this product works right now. It is very likely it gets shipped down to the States and exported from there. But still, Canadian natural gas is some of the cheapest on the planet. And if we can't ship it directly, you better bet we're shipping it down to the States and they're shipping it to wherever in the world has an increased demand. And so regardless of Canadian projects coming online, they'll likely benefit anyways. Okay, we've talked about their numbers. We've talked about their future plans. My last little section here I want to talk to you guys about is valuation. There's no question that right now the PE ratio on this company is a little bit higher than it has been. It's sitting around 15%. But I think that considering the forward PE numbers that I see right now, again, courtesy of FinChat, are a lot closer to that 10 range, that I wouldn't consider this that overvalued. Has it been cheaper in the recent past? Yes. Has it been as strong, as profitable, with as great a dividend in the recent past? No. And again, when you are buying a at-scale, large-size player like this, you pay a premium. Talked about this in my recent video about Canada's rail lines. Obviously, the moat on this company is not quite the same as a rail line, but it's still a large-scale player paying a great dividend. It's a large-cap company that's proved itself with great management. So yeah, you're going to pay a higher price for this company than you might for others, but the forward PEs look good. A 10 forward PE on something that is growing, I don't know, take your pick, compound rate, right? Even if you're looking at the 10% compound annual growth rate over the last 10 years in total return, I would still be pretty happy paying a 10 forward PE for that. And if you're talking about 45% compound annual growth rate over the last 5 years, well, obviously you'd be happy paying a 10 forward PE for 45% compound annual growth in total return. Now, not all of these factors are going to really impact most of our decisions, because we're not really comparing this to the market as a whole. We are really comparing it to its peers. And let me know if you'd like to see that video, because I think there's definitely an opportunity there to talk about how this stock pairs up with maybe a TOU.TO, right? One of these other Canadian natural gas producers, or maybe how they compare, how their revenues and all that compared to their sort of other large peers in just the energy sector, right? Against the Suncors and CNRLs and all the other sort of large scale producers in the Canadian space. I think that'd be a really interesting topic. Now, what do I think of this company? I think it's fantastic. I really do. I think it's an absolutely fantastic company. I think the industry interests me more than almost any other industry right now in Canada. And again, I have been talking a lot about resources because I think that's the cyclical trend that 2024 has been building into. I think we're seeing a lot of dominoes line up at the same time, where this industry is going to be a good space to have your money for the next 5+ years. And it fits really well with my current philosophy, talking about dividend growth investing, looking at building out my TFSA with high paying dividend stocks that I will sit on forever. That is my current investment goal, and Turmaline fits perfectly in that space. I can slot it right into the portfolio. It makes a lot of sense. It doesn't have any huge risks in contrast with most of my other investments. The only thing I would say is, obviously, you don't want to be super concentrated in one industry. While this is natural gas versus maybe liquids, right, in the energy sector, obviously you can't really talk about one without the other. They're not the same, but they're definitely sort of more connected than the oil and banking industry, or the oil and insurance industry, or the oil and gold industries are. Right? So when you look at this from a portfolio building perspective, obviously it comes with that extra risk of being in the same sector that I've talked about so many companies, but I still think this is a natural buy. And I just think you can't look at the kind of numbers this company's been putting up and not be impressed. And those are my thoughts on this company. Please let me know yours down in the comments down below. And again, let me know, would you be interested if I was to compare this to other large oil producers, or specifically to other Canadian natural gas producers? Because I've heard some people are interested in that kind of video. Love to hear from as many of you. And obviously, if you made it this far in the video and you're interested in this kind of stuff, please do subscribe to the channel. It makes a huge difference for us. Doesn't cost anything. Helps the channel out a bunch. And with that being said, I hope I see you in the next video.